I'd like to welcome Mike Shedlock. He is the author of Mish's Global Economic Trend Analysis. It's one of the most read blogs on economics on the internet, and it was ranked by Time.com as a #1 economics blog on the internet. And so I think it'll be a very interesting talk to hear Mish talk today about the state of the economy, but then also how he started with blogging and what the Google products like Blogger has meant to his career. So, welcome, Mish.
Hello, I'm Mish. It's a pleasure and an honor to be invited here to speak at Google. I'm a registered investment advisor for Sitka Pacific Capital Management. I have a blog called globaleconomicanalysis.blogspot.com. That's a mouthful to remember, so the easy way to find my blog is just do a Google search for Mish, M-I-S-H. Every day I write about topics on the interest rates, gold, inflation, deflation, housing, the economy, primarily from a macro point of view. I'm very passionate about what I write. My general advice to everyone in this difficult economy is to find something you like to do it well, because life's too short to do something you dislike to do. I have fun when I'm writing. In fact, often I'm laughing my head off as I'm writing. So I hope it comes across that way, and I hope others are laughing too when they're reading what I write. I'm here not only for Google's world-famous free lunch, but because of Google's free lunch. Here's my story. My background's not economics, or Wall Street, or finance, but rather computer programming. I worked as a mainframe computer programmer analyst for over 20 years for some of the largest banks in the country. Bank of Montreal, Harris, First National Bank of Chicago, First USA, Chase, and others. The last 4 years of that run, I was an independent consultant. I lost a consulting contract after 9/11 and never got another one. I was out of work for 3 years, had no income, and when I tell people to be prepared to lose their job and to have cash saved up if they do, I'm actually speaking from personal experience. For those out of work, being short on cash is no fun. Yet every day, for years, people were telling me that cash is trash. After 9/11, I spent a lot of time on stock message boards, learning everything I could about the stock market and the economy. I had some great teachers, but no income. Somewhere along the line, a hedge fund manager offered me a temporary job, but I knew that slot was going to end in less than a year, so I had to find something else to do. As luck would have it, in early 2005, a person on a stock message board that I run on Silicon Investor posted something to the effect of, "Hey, look at this. Google has these things called blogs. We can post our thoughts on them. They're really cool." He goes, "I just started my blog. If anyone needs help starting theirs, I'll help you." He went on to say, "And best of all, blogs are completely free." Completely free. Those are magic words. When you're out of work with no income, completely free is not just a good thing, it's actually a requirement. I took my friend's offer and he created the first template for my blog in 2005. I started my blog hoping that someone would discover me as a writer. Given there's 10 million blogs out there, that's might be the best business plan in the whole world. But it happened. A few months after my blog was up and running, a company hired me to write a stock newsletter. I did that for a while, about 18 months. However, I'm not fond of the paid newsletter model. There's simply too much good information out there for free at your fingertips just by doing a Google search for things. To break away from the newsletter model, I took and passed the Series 65 exam and then became a licensed registered investment advisor for Sitka Pacific Capital Management. By the way, many people will recognize the name of the person who created my initial blog. It's Calculated Risk. He now has the #1 economic blog in the country by page counts, and I'm number 3. My traffic's roughly 1.5 million page hits a month, and my current business model is ad revenue off of my blog to supplicate a percentage of assets under management at Sitka Pacific Capital Management. Most of my clients found out about the investment opportunities at Sitka simply from linking on a link on my blog. I actually seldom discuss Sitka on my blog. I don't have to. Our returns speak for themselves. With everything going on, keeping my blog up and running is now a very high priority. It's painful when my blog is down, RSS stops working, as has happened on several occasions. I'm grateful for Google's free blogs, and indeed, I might not even be here today without them. However, my viewpoint regarding free has changed because of the necessity as opposed to the desire to keep my blog up and running. I can't afford for my site to be down or to have RSS stop working or many other things that have actually happened to my blog over the last couple of years. Blogger help is non-existent. There's no one to call for help. And the blogger help forums are essentially worthless. So please consider some kind of tiered support for those people bringing in significant ad revenue to Google. I'm asking for a support number. I'm even willing to pay for it. Now there's something. If a deflationist like me is willing to pay for something, there's got to be a ton of other people out there willing to pay for Google support as well. Moving on to the economy. Well, free blogs are a good idea, at least to get started. Free money's not. And we're in this mess because Greenspan threw money at every problem he faced. No matter what the problem, real or imagined, Greenspan cut interest rates to stimulate the economy. In 2002, he cut rates to 1% to bail out his banking buddies, who then were in hock to deepen loans to Latin America that were not performing, and also to loans to dot-com companies that were never going to be paid back. The Fed's actions fueled the biggest credit expansion in history. In Florida, people started camping out overnight, entering lotteries, standing in line to buy condominiums. In the summer of 2005, the cover of Time magazine is "Why We're Gaga Over Real Estate." I looked at that. Wow, gaga. Sentiment does not get much more extreme than Time magazine going gaga over real estate. I looked at that and I wrote a blog post that summer, and I said the housing peak was in. Indeed it was. However, sentiment persisted for a full year that there was no housing bubble. The real estate mantra was all real estate is local, even after state after state after state started blowing up. Sentiment then morphed into a, don't worry, it's just a subprime problem. And that mentality lasted another year. Even after Bear Stearns blew up, Ben Bernanke, Fed chairman, came out and said the problem was well contained. Well contained. A short while later, the Fed embarked on the biggest rate-cutting campaign in history. Lehman went bankrupt. AIG went into receivership. And had it not been for massive government bailouts with taxpayer money, Citigroup and Bank of America would have gone under as well. Yet, you still hear the claim, no one saw this coming. Well, they weren't reading Calculated Risk, Naked Capitalism, The Big Picture, Nouriel Roubini, or my blog, or for that matter, any number of hundreds of other blogs who all called this crisis better than all the economic experts. Now, instead of listening to the people who called this in advance, the Obama administration, like the Bush administration before it, is taking advice from three groups of people. Those who caused the problem, those who didn't see it coming, and those who believe throwing money at the problem is going to fix it. Japan proved without a doubt that throwing money at the economy to jumpstart it does not work. All it does is sink a country deeper into debt. Unfortunately, that is the path that we've embarked on, thanks to Geithner. What I find interesting is the average 8th grader can understand that if reckless lending and easy money created this mess, then reckless lending and easy money cannot possibly be the cure. Meanwhile, we've got Nobel Prize-winning economists that can't seem to figure this out. Actually, I can rant about this for hours, but I think your time might be better spent by addressing what's on your mind, not mine. So with that, I'll take any questions anyone has. The question is, it looks like the stock market's heading back up. Where is the economy heading? Is this a false temporary blip? Well, here's the way I look at it. All they've done is attempt to recapitalize banks at the expense of taxpayers. They've still not done anything to help out people who are out of job, people who are underemployed. I have people emailing me that they're working part-time now for 10 hours, and they used to be working 40 hours. All of that is still putting pressure on real estate prices. Real estate prices, I don't think, are going to come back until 2012 at the very minimum. And I see no source of driver for jobs. housing was a huge driver for jobs, looking back a few years ago. I think Greenspan actually created a bubble on purpose, like I said, to bail out his banking buddies who were ad hoc to dot-com companies that were going under. So, and look at all the jobs that housing created. You know, the trucking of stuff in from China, appliances, carpentry work, roofing, home building, granite countertops, even grass seed and plants for the lawn. And then, you know, trucking all of that stuff around. The truckers ate at restaurant truck stops. I don't see any source of jobs that can possibly fill that void. So, you know, yes, at some point the economy is going to bottom, but without a driver for jobs, and the Greenspan was very lucky. He had an internet boom and a housing boom. I don't see where Bernanke's going to have any such luck under him, because I don't see what the next wave of technology is that's going to create the jobs that either the internet did or that the housing did. So at some point we're going to smooth out here, as in stop declining. But I don't see that the economy is going to come roaring back anytime soon. And with that in mind, the stock market is still very richly priced. Now, we don't know, no one knows where the stock market goes. People ask me all the time, you know, Mish, where's the stock market going? Where's gold going? Where are interest rates going? It's funny, everyone has an opinion on that, but the real answer is they don't know, and I don't know either. But what we can say is these conditions still aren't very good economically. My own idea is kind of that the stock market's going to go nowhere in an interesting way. We've had this rally from 666 on the S&P 500 all the way up to, well, we're over 900 today. But, you know, I look at that and say, well, at some point we're likely to retest that bottom, go back down there and test that 666 level. Maybe it holds, maybe it doesn't. But given that there's no source of jobs, real wages are falling for most people. And so I think the stocks are still richly priced. I think something like this is going to happen. Maybe the stock market rallies another 100 points to 1,000, falls back down to 700, rallies to 900, falls back to 800, rallies to 850. I think the market's going to do something like that over the next 4 or 5 years, actually. And that's my good scenario. My bad scenario is we fall back into a double dip recession, which is, I think, actually going to happen. When this one ends, we're going to slip back into it. And my bad scenario would have the S&P fall to maybe 500 and then bounce between 500 and 1,000 over the next 5 years. So, but we don't really know. It's important to take your cues from what the market is doing, not what you think it ought to be doing. I certainly saw this bubble coming from a long ways off, calling the housing bubble at the top of in the summer of 2005. But it took 2 full years more before the stock market started going back down. So started heading down in an earnest way. Then it just crashed. So, you know, we can see some sort of recovery here. I think it's a false recovery just because there's no source of driver for jobs. So, but it's important to take your cues from what the market is doing, because people that have seen this and have that same viewpoint have been shorting the market lately, and they've been getting their heads handed them, blown out of the water. So we try and follow what the market's doing and invest accordingly.
Have you seen any markets or countries who are doing something that you think is positive?
Doing something positive. Do I see any markets or countries that are doing anything positive? Actually, there's only one, New Zealand. The Prime Minister of New Zealand came out and said, you don't fix problems by throwing money at them. But everywhere else in the world, they're trying to fix problems by throwing money at them. In the United States, in the UK. The UK is arguably much worse off than the United States even. Canada, Australia, everyone's cutting interest rates, trying to stimulate the economy. Our own Congress is upset that banks aren't lending. And I keep asking myself, why should banks lend? What is it we need more of? Do we need more Pizza Huts? Do we need more Walmarts? Do we need more Home Depots, Lowe's? Do we need more Targets? What is it we need? Nail salons? What is it we need? And I don't come up with the answer to that. Yet Congress wants banks to lend. The irony here is that banks are acting responsibly for the first time in a decade by not lending, and Congress is trying to force them to lend at a time when businesses have no real need to expand and consumers don't have a job and can't spend. So all forcing banks to lend will do is cause more write-offs down the line.
You've argued a number of times on your blog that we're in a deflationary regime, persuasively I might add, because I think what you said was the money that's being pumped into the banks is just staying there and not being lent. I guess the question for those of us who are long on dollars right now is when do those, under what circumstances does that money start to come out and turn into inflation again?
Okay,
When does it come out to play?
the question is, the Fed's been pumping a lot of money into the economy. My view has been actually that we're in a period of deflation. And then the question is, what happens to those dollars that the Fed is trying to do? I have an analogy, and let's say that I invented the perfect printing press. And the printing press was so good that I produced dollar bills, $100 bills, that the Treasury itself could not tell from the real thing. And let's say I went out and printed $1 trillion worth of these things. Certainly if I went out and started buying things, prices of goods would start rising because of this money injected into the economy. But if I print $1 trillion and bury those dollars in my backyard, what happens? The answer is nothing happens. That money doesn't make its way into the economy, and so prices of goods and services aren't bid up. We've got a situation now where the Fed has printed tremendous amounts of money, but it's just sitting there at banks. Banks don't want to lend it, as we just talked about. So as long as that money's sitting there, it's not going to affect prices of goods and services. Now, the Fed's desperate to have banks lend, but banks simply aren't lending because there's no reason to. Now, at some point along the line, the Fed's going to have a huge problem. I don't know when that period is, but that money does start to filter its way into the economy, and the Fed's going to have to slam on the brakes. That in and of itself might cause a second recession when they do that, when they try and react to what's coming down the line. But right now, we're in this environment where boomers are heading into retirement with who thought that their home was going to be their retirement. Then they thought the stock market was going to be the retirement. And now they're finding they're heading into retirement with they're underwater in their home, or it's not worth as much as they thought it was. And they don't have enough money in their savings, in their stock plans to meet what they plan to do during retirement. So we're going to see boomers heading into retirement, traveling less than they thought, buying fewer toys than they thought, cars, boats, and the like. So, and in fact, some of them are so cash-strapped that they're actually competing against their kids and grandkids for jobs. You got these people that thought they had money saved up, they don't. They need to supplement their income, so they're looking for a job. So where do they go? Just look at the age of some of the people at Target and particularly at Walmart, the greeters. These people, 62 years and older, they're competing against their kids and grandkids for jobs. And the reason why Walmart hires them is for medical reasons. People over 62 have Medicaid. So the government would rather hire them than someone that's 25 or 30 years old with kids and have to be able to manage their health care. So, we've got this competition for jobs. We've got boomers that are going to start saving, and already we're seeing the savings rate start to go up. But the biggest thing is consumer attitudes towards debt have changed. It's now cool to be frugal, to save money, to not spend. People aren't flaunting their wealth like they used to. They're trying to downplay it. All of that, brings about a completely different attitude, and that's what the Fed is fighting here. It's attitudes. And attitudes are like super tankers. They don't turn around very easily at all. And we've seen consumers go from the most reckless, overbuying, willing to go into debt over anything, to an environment where they're going to have to save. In this kind of environment, it's very unlikely for the Fed to be able to spark serious inflation. So, at some point we're going to see it again, but I don't think it's going to come rousing back. And certainly all the hyperinflationists have been dead wrong about what's happening. And I believe they're still going to be wrong, because even when inflation does come back, it's not going to be this big, massive inflation that everyone's expecting. The question is, what would I do if it was up to me? Because what I would do is I would bring the troops home from Iraq. I would bring the troops home from Afghanistan. The U.S. can no longer afford to be the world's policeman. We're spending a lot of money overseas. It's just totally wasted. Bombs don't add to GDP. They subtract to it, even though it looks like we're adding to it. Blowing up Iraq did nothing but cause us to go back in there, and now we're trying to fix it. That's costing us money. We've got troops stationed in Japan, Europe, literally all over the world at tremendous expense. So I would bring those troops home. I would offer them first crack at any infrastructure jobs that we create. I don't have a problem with repairing bridges or fixing potholes. It's something that needs to be done. So I would bring the troops home from Iraq. I would offer them first crack at any of those jobs. And I would just let a lot of the rest of it just play out. The Fed has a history of making problems worse. Greenspan made this problem worse by trying to bail out his banking buddies. So we can't do the same thing. We're going through a period of adjustment, and there's things that we can do, like I said. Stop wasting money, fix potholes, repair bridges, maybe do some other things. But I think the best thing to do is actually just let it play out.
How would you compare the bank situation in the U.S. today compared to the 90s banks, Japan? And what would you do to fix the banks today?
The question is, how would I compare the banking system today to that of the 90s and Japan? Actually, I think we're following the same path of Japan, and which is one of the reasons why I don't have hope for a very strong recovery. Japan started building bridges to nowhere, not just fixing them, but actually building bridges that weren't needed. When you do things when you spend money in ways where it's not needed, there's no economic result, long-term lasting economic result as a result. The interest on the national debt is going up. That's going to have to be paid for. Now, either we pay for that, or we pay for that by a cheaping dollar, or our kids or grandkids start paying for that down the road. So this situation is very much like what Japan went through. And anyone that thinks that the U.S. stock market is going to come roaring back ought to look at how Japan's stock market reacted. We're 20 years into this thing. 20 years ago, roughly, the Japanese stock market was at 40,000. It's at 9 or 10,000 today. So people in the United States, you might not think that that's going to happen, and maybe it doesn't, but I'm saying that can happen. And that would be along the lines, actually, of what I expect. For the next, certainly 5 years, I don't think the stock market's going to go anywhere. I could be wrong, but for those people that are heavily invested, expecting returns out of the stock market, I would say those returns are likely not coming. Here's a question. In the past, you stated you see a deflationary recession in the U.S. unless Congress does something crazy. Do the recent actions and bailouts qualify? Well, they certainly qualify as crazy. But I don't think that they qualify as being enough to cause hyperinflation as people think. And the reason is, we've destroyed trillions, 10, 20 trillion dollars worth of wealth, real and imagined actually, in the housing environment. And for the reasons that I outlined earlier, people aren't going to be spending heading into retirement. They're going to be saving. And even what they do spend on is not going to stimulate the economy much. Already we're seeing taxes go up. Take a look at California. There's fees for everything now. They're putting in these traffic light things to catch people, trying to raise money by fining people. Well, you know, all that just takes money out of consumers' pockets and puts it into the hands of the bureaucrats, which is the last place you want it. So, you know, none of that is going to, you know, cause any sort of productive, you know, capacity or anything that's going to get us out of this funk. And I think the stock market's eventually going to reflect that, which is why I don't think it's going to go anywhere. So yes, although Congress has done something, you know, really crazy here, they've wasted a lot of money. So far, anyway, it pales in comparison to the destruction of wealth and credit, and the destruction of credit that's yet to come. We're losing 600,000 jobs a month. We have for the last 4 months. I expect we're going to lose 600,000 jobs a month, for the next 4, and then keep losing jobs after that for quite some time. Well, people out of work there's going to be more pressure on home prices, less spending that people are going to do. So all of these reasons, I don't think that we're heading for this hyperinflation that everyone thinks. How did you get introduced to Austrian economics? Actually, I got introduced to Austrian economics back when I was out of work, you know, looking at things, trying to figure out how the economy really worked versus what all the talking heads in Congress and then Treasury Secretary Paulson was saying about how these things work. So Austrian economics is sound money, hands off, let the economy work its way out. And certainly I would agree to all of those things. We don't need a Fed. Right now they're talking of having this super regulator or giving the Fed even more powers. Bernanke 2 years ago thought this was contained and was not going to spread beyond subprime. So, you know, how is it that the people who didn't see this coming, and how is it that Greenspan, who created the biggest housing bubble the world has ever seen, how is it that giving these guys more power is a good thing to do? I would be in favor of abolishing the Fed and fractional reserve lending. Take a question out here.
Yeah, there is some indicator that the China economy may start to recover. What do you think?
I didn't understand the question. Try again.
There is some indicator that the China economy may start to recover.
Will the Chinese economy start to recover? Well, China has one advantage, if you consider this an advantage. They are, in a lot of ways, less free market than we are. They still have a centralized command economy that if the government tells banks to lend, guess what? Those banks in China are going to go out and lend. So you're seeing some seeds of false hope now, I think, in China, where you know, they're doing all these infrastructure products. But think about what China's really doing here. They're adding to capacity when we're awash in capacity. We don't need any more cars. We don't need any more manufacturing plants for washing machines, for refrigerators. The toy business in China is devastated. The average a doctor in China makes $20,000 a year. A doctor would be a relatively high-class person in China. Meanwhile, the condos that they're building in Shanghai, all the big cities, things are going for $600,000, $700,000. Who can afford them? You got a lot of empty condos sitting there in China. You've got a lot of stores, all stuffed with the same merchandise. You walk into a store in some of these places, and there's 10 people. You know, you walk into a Home Depot, you can hardly. Ooh, we got the mic back. Walk into a Home Depot here in the United States, you can't find someone to help you. You walk into a store in China, and you might have 10 people all trying to help you. So it's a big difference. And so anyway, so yeah, China is trying to stimulate their economy, but the whole world is. But stimulate it for what? Because I keep coming back. You know, at some point, I think, you know, China is going to be the dominant force in the world. Just as the UK passed the torch to the United States, I think somewhere down the line, just on the basis of population, I think the U.S. might pass the torch to China. But that's not anything that's going to happen in the next 10 years or even 20 or even 30. But China, unlike the U.S., thinks in terms of decades. So, you know, they're willing to go through some of this. They're willing to do some of the things that they are doing with an eye down the road. In the United States, yeah, we have a hard time looking down the road. But anyway, I think all these green shoots that people are talking about, whether it's China or the United States or Europe, is really just more malinvestments by government throwing money at problems. And one has to ask, what happens when they stop throwing money at problems? We slide back into recession. That's what. It's an artificial boom that's being created right now, and that's all we're seeing worldwide on any of the recoveries we're seeing, whether it's China or the United States. These green shoots, in my opinion, are a mirage.
If the banks are being responsible by not lending, then what will be the driver of growth in the economy?
Savings is always the driver of growth in our economy. You can't spend what you don't have. In Austrian economic terms, savings is what's left over after production. Well, an apple grower produces 40 bushels of apples and consumes 2 or 3. You know, the rest of that is savings. Now he can lend that to, or use those apples to perhaps buy shoes or other things. And we need to get back to that. Somehow we've got this idea that we can just, you know, print money out of thin air, and that's going to stimulate anything. It doesn't. The only way you can really get money to lend is by people saving. It's the excess savings from production that fuels the economy. So they've got it ass backwards. Anyone that says, well, we need to spend money to get the economy going, no. We need to actually save money, have money saved up, use that money for investment purposes. So all the mainstream economists, including Krugman, are just completely wrong in this point.
Speaking of China, when do you think Chinese people will actually stop buying U.S. Treasuries?
The question is, when will China stop buying U.S. Treasuries? That's an interesting question, and most people don't really understand the situation. The answer is China must buy U.S. Treasuries. And the reason is the United States is running a deficit. By definition, if the United States is running a deficit, some other country in the world must be running a surplus. So what are they doing with those? They're getting dollars in return. Some people said, well, you know, why doesn't China buy oil with those dollars? Okay, so China buys oil with the dollars. And what does Saudi Arabia do with the dollars? Those dollars are out there circulating around. Those dollars eventually have to come home. And the way those dollars come home is China buys U.S. assets. Right now, it's U.S. Treasuries. Now we've seen Dubai try to buy ports, and they were turned down for security reasons. But eventually, you know, China's going to be buying U.S. businesses. That's how those dollars are going to return. But as long as there's a deficit out there, people say, "Oh my God, China's going to dump treasuries." By definition, they can't. And mathematically, China or someone must be accumulating U.S. dollars or U.S. dollar assets by the very nature of the fact that we are running trade deficits with most of the rest of the world. You are correct that it was spending in World War II that more or less ended the Great Depression. But was it really the spending? I think people are looking at correlation, and correlation and causation are not the same thing. Wars are never a good thing. Wars are very destructive. What happened after World War II is the world's productive capacity was thoroughly trashed. Countries, Europe was obliterated. The U.S. had the only production capacity left in the world after World War. Japan was obliterated. Germany was obliterated. The U.K. was bombed. So we had our productive economy. So from our point of view, the economy boomed. But look at what Japan went through. Look at what Germany went through. Look at what the UK went through. And ask yourself if war was a good thing to them. It wasn't. So looking at that government spending is only looking at things from the point of view of the United States without ignoring what happened to the productive capacity of the entire rest of the world. So, but then, you know, boomers came home. They started raising families, more kids, more growth, wanted toys. The world economy eventually recovered. And I think that's the lesson here, actually, that economies will recover on their own accord if the government just gets out of the way. By trying to stimulate the economy, we create false booms. We have this never-ending cycle of boom bust. And I think the housing bubble actually was the bubble of last resort. I'm hard-pressed to think of another bubble that can come by that would be bigger than that housing bubble that we just created. So, and you see government spending and you say, oh my God, you know, look at this, the economy's humming. No, it only looks like the economy's humming. Look at all the malinvestments we created. We created malinvestments in housing. We created malinvestments all across the line. When government spends money, it creates a false economic signal that, that everything is well, that businesses go out there and expand, and then eventually these things blow up. Under Austrian economics, where we would have sound money, these boom-bust cycles like this wouldn't occur. Now, we've never had an environment where we've had a true free market with no fractional reserve lending. So, in fact, I wrote a blog on that today, so you might want to read that blog. And it's called The Case Against the Fed in Fractional Reserve Lending. It's a lengthy piece, so go out there and read that. But history is actually replete with examples of how government makes nearly every problem worse.
Let's take another. Okay. Yeah, you can go ahead.
Okay, I'll do this one. Another question here on the computer. You've written gold does well in deflation because gold is money, but gold hasn't been a medium exchange for decades. Why do you think gold will continue to do well in this deflation? Well, I think gold is money because it acts like money. We look at gold in comparison to all the rest of the commodities during this last crash. Copper crashed, oil crashed, corn, everything across the board. The only one that didn't crash is gold. I don't think that government decree alone can stop gold from being money. Throughout history, people have kept gold as money. And we're seeing that again here right now. And in deflation, the value of currencies, the senior currency, or the value of gold should be expected to go up. And certainly it has. If you look at the price of gold actually compared to copper or compared to the stock market, so, you know, gold has soared from 250, excuse me, to over 900, where it's sitting now. And in the meanwhile, housing prices have crashed. Oil, which was soaring, outperforming gold when we had an inflationary kind of environment until everything crashed about a year ago. Now the amount of gold in almost any other terms, gold in terms of oil, gold in terms of copper, gold in terms of house, gold in terms of stock market. Gold has done very well, which is what it normally does in deflation. In the Great Depression, gold and gold miners were about the only winners in the stock market. And while it's not the only winner today, it's certainly held up. And in deflationary periods, gold does well in real terms, not nominal terms. And by real terms, I mean in comparison to what gold can buy. Like I said, gold versus copper, gold versus housing, gold versus the stock market. So gold doesn't necessarily have to soar to 5,000 or anything like that, you know, some people are claiming. I just think it's a good investment in this environment. Gold does well at times of credit stress. Gold is not an inflation hedge at all, in my opinion. Certainly we had inflation from 1980 all the way to 2000, And gold fell from over 800 down to 250, and we had inflation the entire length of time. So people that say, well, gold, does well in inflation and gold does well in deflation, actually are misstating what's actually happens. Gold does well at times of credit stress, and when there's a boom on, we got the opposite of a credit stress, and that's actually why gold collapsed in spite of having inflation all the way from 1980 to 2000.
Hi. So I have a question about the fractional reserve, FRB basically. And it's actually not specific to FRB, and I apologize I haven't read your post this morning, but I did read most of your posts in the last few years. So just to actually kind of clarify where I'm coming from, we actually agree on a lot of things, but I still have a very specific question about the FRB. So I'm trying to understand the objection. Is the objection something that is common to any sort of government involvement? Or if, for example, FRB would be something that is completely clear, meaning a depositor will have two options: going to what I guess people refer to as money warehouse, where your money is stored there, and you may actually have to pay for that storage because it cannot be lent to somebody else. And some other people can go and put their money in what currently existing bank. There's no FDIC, or if there is FDIC, it's more of a trade group than a government-backed insurance. It's just like any other insurance. And would you be okay with that? Because it's one of the issues that I find really difficult with a lot of dogmatic Austrian economists. And I would even just take it to the next level. My problem with banning FRB is, by extension, you have to ban any form of securitization. You have to ban any form of what people refer to as, the innovation happening of financial engineering. And my last question, I'm sorry, just to make it complicated, is did anybody consider the cost of banning any of these things? Because to me, the issue is, what is the actual cost of borrowing, or what kind of imbalance it would create between the people that have money and the people who don't have money. And not everybody who doesn't have money is actually a credit risk. A lot of people, want to buy a house assuming they're going to make that money for the next 20 years and not wait 20 years when they saved all that money up to buy a house. And what does prevention of FRB and any financial engineering does to that balance?
Wow, there's a lot of questions there. First off, let me say that fractional reserve lending is fraudulent in and of itself. And one of the reasons why prices keep going up to the point where people can't afford to buy things is because of fractional reserve lending. Fractional reserve lending allows banks to lend out more money than they've got. And not only that, Greenspan in 1994 authorized sweeps. Sweeps of checking accounts, unbeknownst to probably almost everyone. Money is swept out of checking accounts nightly. The money you think is in your checking account isn't there. It's been swept out into a savings account. Now, you don't see that, but it's happening. The savings accounts have no reserve requirements on them at all. So Greenspan allowed these sweeps to happen. Banks lend out that money. That money isn't there. All that money, goes to fuel the price of assets until we have a crash like we just did. So the money fueled housing, the money fueled stock market, money fueled all sorts of other things. People thought that it was wealthy. And in contrast, the question was saying, well, there's, not enough, they need to do this. No, by lending money that they don't have, the Fed guarantees, until we have a crash like we did now, that there's constant inflation. Inflation is theft, actually. Inflation is theft against savers. It makes money that people are saving become worth less and less over time. If I started a bank, not a bank, if I started a corporate company that let's say I took in gold and started lending out gold, and I lent out more gold than I had on deposit by offering people receipts that they considered to be good for gold, and I lent out 10 times more gold than I had. I think the government would probably crack down on me, but somehow it's okay if banks do that very same thing. We had banks, you know, Lehman, Bear Stearns that blew up. They were leveraged 40 to 1. Now, while that leverage is going out there, it's helping to fuel asset prices. We see the reverse when asset prices start when asset prices start falling. We see banks that are undercapitalized. They have to raise capital, and right now they're putting that burden on taxpayers right now, which is also wrong. But fractional reserve lending does not mean no lending. Fractional reserve lending, it's fine. You know, if banks want to lend, I have no problem with banks, you know, lending out the money that's on deposit. I have a problem with the banks lending out 40 times more money that's on deposit. That fuels asset prices, that fuels these boom-bust cycles that we went into.
I read your blog every day. I think it's great, but unfortunately, I don't matter. I don't make any decisions. I don't feel any influence. How are you using sort of the popularity of your blog as an influence tool? How do you feel that's going?
The question is, how am I using the popularity of my blog to influence? Actually, you know, I don't have a lot of say either, unfortunately. But collectively, I think we all do. And I think the change is going to have to come from all of us collectively. When they were trying to pass that first TARP plan last year, I organized a phone-in, fax-in, call-in, write-in campaign. Perhaps some of you here participated in it. But one weekend, we filled up the voicemail box of every legislative representative in the entire Congress. Their voicemail boxes were filled up. I think the President Bush and Paulson were actually shocked when Congress actually did not pass that bill the first time. Of course, then Paulson comes out and promises financial Armageddon if people don't pass it, so it did pass 2 days later. And the stock market promptly crashed anyway. But I'm hoping to, in fact, I plan, not hoping to start something up again. I've actually promised to do that, but I wanted to wait until some of the Obama glow has worn off. When the first 100 days, you know, everyone was willing to, you know, almost bow to the administration. It was going to be very hard to, you know, step in and come in and say, you're doing this and this wrong. You know, no one's going to want to listen to that. I think the time is ripe now. We're starting to see some people, you know, question what authority the Fed should have, both Republicans and Democrats. It's going to be a long slug, but we're going to have to start somewhere, and we're all going to have to get involved if we want to fix this problem. So look for, you know, some things on my blog about more, you know, contacting the Fed, members of Congress, legislative representatives, and I think what would be really important is we could just get, you know, everyone interested in this kind of thing to meet with their legislative representative one-on-one, you know, present the case against the Fed and try and get them interested. We need to abolish the Fed. That's one of the first things we need to do. And certainly that's going to take a massive effort to get that to happen. But I think it's actually doable.
I think we're almost out of time. We have a few minutes for one more question. Let's take a question from the internet. And then if anyone would like to join us after this talk for lunch, then feel free to.
I don't see another question on here. I'll take one from the audience.
Okay.
Have you considered using your prodigious voicemail bombing power for House Resolution 1207, the Federal Reserve Transparency Act?
Is that Ron Paulson's bill?
Yeah, I think it's Congressman Paul's bill.
Okay, yes. Actually, I wanted to do that. I mean, that's just a small step in the right direction. I think my fear on passing that, are you talking about the audit of the, is that the bill the question is, do I support the bill to audit the Fed? Certainly that needs to be done, but the Fed really doesn't need to be audited. It needs to be eliminated. I've got a stack of business cards over here on the table over here. Anyone has a card, anyone wants a business card of mine, please pick it up. My blog's not on there, but reference to Sitka Pacific Capital Management and a way to get a hold of me via emails on the card.